and we're going to bring up our panel. Let's do it. Let's talk about sale leasebacks. We have Meryl Ross. How are you today?
Oh, great. How are you?
I'm fantastic. I'm great. I'm really excited for this conversation. I'm going to get out of here, though, and I hope you all know what the first state to legalize medically was, and I'm going to leave it at that and get off. Thank you so much.
I'll concede that I think it's California. I'm going to introduce the panelists in a minute here, but I just wanted to say that we're going to address a slightly broader topic than just sale leasebacks, as the title suggested. We're going to talk about other forms of debt and credit facilities that our panelists offer to cannabis operators. The panel is really nicely divided between public companies and private firms, between net lease REITs and commercial finance companies. So you're going to get a nice diverse set of opinions, and we're going to hear from some people who have been involved in the industry for years and some pretty new entrants. So I think we have a nice balanced presentation for you, and hope you enjoy it. I'm going to ask each panelist to introduce themselves, and I'm going to go alphabetically by the company name. So that leaves Len Tannenbaum at Afc Gamma. Go ahead.
I get to go first. Great. Afc Gamma is a lender to cannabis companies secured by cash flows, licenses, and real estate. We're listed on NASDAQ, symbol is AFCG, and I think our RPO is about 2 months ago. So that's us.
Yes. Next up, we have Paul Smithers from Innovative Industrial.
Thanks, Meryl. I'm the president, CEO, and co-founder of Innovative Industrial Properties. IIP is a REIT that has a strategy of acquiring licensed cannabis production facilities in those states that have adopted cannabis programs. Since our IPO in 2016, we have entered into long-term sale leaseback transactions with most of the top multi-state operators in the country. Our leases are all triple net, have an average yield ranging from 11% to 15%, with 2.5% to 4% annual escalations, and have a weighted average lease length of over 16 years. We currently own 73 properties in 18 different states with 25 different operators, totaling about 6.6 million square feet, and we are 100% leased. We remain the only U.S. cannabis-focused REIT listed on the New York Stock Exchange and have a current market cap of about $4.3 billion. Since our IPO, we've raised over $2 billion and have invested over $1.6 billion with licensed operators through our sale leaseback program. In 2020 alone, we invested approximately $700 million and are on track to meet or beat that number this year. And just last month, we were pleased to announce our debut bond offering, where we were able to raise $300 million on a 5-year unsecured note with an investment grade rating. So we're pretty happy about that. So,
yeah.
Thank you.
It's going to be a good year for you, huh? Yeah. Next up, we have Anthony from New Lake.
Great. Thanks, Meryl. Thanks for having me. Anthony Coniglio, President and Chief Investment Officer at New Lake Capital Partners. We were founded about 2.5 years ago. We've raised over the last 2.5 years across 5 rounds over $300 million. We are a triple net lease REIT similar to IIPR. Today, we own 25 properties across 9 states with 7 different tenants and some of the leading operators in the industry. So we're excited to be here and have this conversation with everyone.
And thank you for coming. Last but not least, and I think Rob has presented so many times at Benzinga that he probably needs very little introduction, but go ahead, take it away.
Thanks, Meryl. I'm Rob Seacrest, President and co-manager of the Polaris Equity Group and the Polaris Fund. Polaris Equity Group focuses on doing value-add bridge lending to licensed cannabis transactions across the nation. We focus on acquiring and building out these facilities. We're fully secured by the real estate. And we've been in the sector. We were the first dedicated lender in the sector in 2016. Since that time, we've originated 50 transactions for over $177 million, with almost half of that already paying off. We launched our private mortgage REIT in 2018 and converted to a private. We launched our fund in 2018, converted to a private mortgage REIT in 2020, And we're really happy to be here today to round out. You've got a publicly traded mortgage REIT, and you've got a couple of traditional REITs, one publicly traded and one private as well.
Yep. It's a very nice, diverse panel. And to that end, I'd like to ask each of you to describe your product offerings and talk about the type of financing you provide and what companies you're most likely to lend to. Are these multi-state operators? Are they vertically integrated? Are they single license startups? I think you'll be able to differentiate as you listen and between these companies because they each have a different level of expertise. And I'm going to reverse the order and start with you again, Rob.
Okay. So our focus has been in the bridge lending. We're typically doing 18 months term loans for the acquisition build out of these facilities. We have high performance capital and we're facilitating unlimited amount of draws in any 1 month. We're typically doing transactions from 5 to 20 million, and those transactions are nationwide. We're willing to look at any of the licensed states out there. As far as the operators or the tenants, they do not need to be a multi-state operator, but they need to be very experienced operators. So we're looking at the quality of the operator, the quality of the sponsor that's guaranteeing the loan, and obviously the real estate as well. So people come to us to get these facilities acquired and built out, and then they're either going to refinance with a more traditional lender or lower cost lender, or go to one of the alternative REITs for the purchase of the property and cash out those funds.
Yeah, and I think that's a neck break because I'm next. That's a great segue into, Rob and I often talk about, right? He would do the early stage and then nice takeouts come into the sale leaseback transactions. And so for New Lake, we're a sale leaseback REIT. We acquire properties and enter into long-term leases so that the operator can operate the property over 15 to 20 years. It's noteworthy. We often get people asking the question, is there any interruption to our business? So this transaction takes a real estate asset, which in our opinion is better held by real estate investors as opposed to investors in the actual operating business. We think that investors in the operating business want the company and the MSOs or the single state operators to actually use their precious capital to operate the business, grow EBITDA and grow sales. Who do we typically do transactions with? Again, these are sale leaseback transactions that we will do with multi-state operators as well as we've done single state operators. We will do with dispensaries as well as cultivation facilities, processing facilities. We've done small one property transactions. We've done multi-property transactions, as many as 10 at a time. And so it really spans the gamut. I would echo Rob's comments in terms of the operators that are best suited for these types of transactions. They're operators that are established. Again, they don't need to be multi-state operators, but they have to have experience operating in this complex industry and a demonstrated track record of success in, if they're not profitable today or cash flow positive, making strong progress towards getting to cash flow positive or profitable. And have a meaningful equity base. We often see people who are startups that have no real equity, and it's really difficult to enter into a 15 or 20-year lease with an organization that's very thinly equitized and hasn't demonstrated the opportunity to grow revenue and to start getting towards profitability or even get free cash flow. I think that goes over to Paul at this point.
Yeah, Paul.
Sure. Yeah, so, our current portfolio of 25 different operators is about 80% MSO, but we're always looking for opportunities with well-qualified single state operators. And in fact, many of our current MSOs were single state operators when we first began our partnership with them. About the 75 properties we own, 10 of them are retail, so the vast majority of our asset portfolio is in cultivation and processing. We tend to focus on cultivation for a number of reasons, chief of which is the scale of the asset. Our cultivation facilities can be as much as $50 million, where a typical retail may be $1, $2, $3, or $4 million. I think the operators of the cultivation facilities tend to favor longer term leases, which we also prefer. So again, we're 100% sale leaseback. All our leases are absolute triple net, which means the operator pays all insurance, property tax, and all property level expenses for the lease duration, including any capital expenditures and repairs and maintenance. So, our lease length range between 15 and 20 years. We don't have any purchase options or early termination clauses in our lease, and we do typically get a corporate level guarantee from the operator, but no personal guarantees from any of the individuals.
And I guess I'm next or last. So my previous business, we built one of the bigger middle market lending firms. And how we did that, we had over $5 billion of assets. I would underwrite and distribute over $1 billion a year to the middle market. Taking that lending expertise to a market that really had been dominated by sale leasebacks and IIPR, we're offering alternative to our customers in that they don't have to do a sale leaseback and lock up their asset for 15 years with escalators. They now can take a 3 to 5 year loan and pay it back with a prepayment penalty even in the second year. If you believe SAFE Act is passing and some other things, and you believe this industry is going to have yield compression, to offer a shorter term loan and not having to be able to own your real estate over the long term may even provide a cheap source of capital. So having that alternative and having built a 100-person organization, which I sold to Oaktree as a $5 billion asset manager, we've currently lent in 14 states. We have 13 loans. We're active. We did $50 million in the first 6 weeks of this quarter. And so we're really seeing a demand for our product from customers, which include multi-state operators, single state operators, license holders that want to build something if you put enough equity and have a proven and demonstrated track record of being able to build. We understand what the license values are. We don't currently lend to California, Oregon, or Washington. We really focus on the limited license states, those where the supply and demand dynamics we can understand. So it's a different type of model. We do a lot of construction financing like Rob does. Typically, our loan sizes are between 10 and 50 million. My hope next year is to write $100 million checks.
Well, that's a good goal. What kind of returns do you try to generate for your stakeholders? What do you think to accomplish in the next 12 months? I mean, Len just summarized it, but maybe we can just put in comparatively into context the difference between the risk and reward of a net lease operator versus a commercial finance company.
Which order do you want?
Let me say, who wants to go first? Maybe Paul, can we start with you?
Sure. Well, we're a public company, so I think the returns our investors expect are appreciation of our share price. We also pay a dividend that we've been able to increase quarter to quarter for the last 12 quarters. So, if you bought our stock when we came out at $20 a share in December of 2016, you'd have about a 900% return on that share. So, stocks perform very well. We pay the dividend. So our investors look at that. They like the liquidity of having a New York Stock Exchange listing. So that's attractive to our investors. Now, I'm not sure if you want to talk about why a sale leaseback may be preferable to a mortgage. We talk to a lot of our operators, and while there are certainly some advantages to a mortgage product, a sale leaseback is wonderful. First of all, obviously it frees up the capital that's stuck in real estate for these operators, and they need capital now. What they also like is the certainty of a 15 or 20-year lease with us. They know what their mortgage, or they know what their debt payment or lease payment's going to be year over year, and they're not the idea of getting a mortgage in maybe 3 or 5 years from now, having to pay that off, nobody knows what that's going to look like if they have to go and refinance. So there's a lot of certainty in the sale leaseback model.
Can you give us an idea of how much business you expect to do in the next 12 months? You referred to $700 million in last year, and increasing that. Maybe talk about how much it increased since 2019. So that we'd have that year-over-year comparison rather than making a projection.
Yeah. So with our recent bond raise of $300 million, we've always told this street that when we do a capital raise, we expect to be able to place that capital within a 6 to 9 month time period. We're confident we can do that again, if not well ahead of that. So the pipeline's very strong. I think we did about 600 or 700 million last year in acquisitions. I think we're certainly on track to meet or beat that this year. We're getting all sorts of pipeline requests from our existing tenant that they want to expand maybe the facility we already own. So they come back to us. Maybe they're in New York, just got a rec program, and they need more money to expand to meet the demand. We're also seeing some requests for M&A activity and acquisitions that these operators need capital. So they're looking at sale leaseback. And of course, the growth of the industry is tremendous. With the new states coming on, the projected 30% annual growth, just a tremendous demand for this capital.
That's certainly true. Rob, why don't you
Sure.
pipe in here?
Sure. We're a private mortgage rate, so our share price is going to be non-volatile and always be $1. So that's why we've chosen to stay private. Our dividends have been consistently over our target of 15% each year that we've been operating this fund, and we're at 19% right now for the year to date. Those returns, we already know what they're headed for the next 18 months. That's what we write our loan terms, so we will continue to outperform this year. As far as growth from the last year to this year, we had a 14x growth from last year to this year. And in the next 90 days, we'll put out $50 million worth of transactions, and we expect to put out $100 million in no less than 180 days for the rest of this year.
Awesome. That's good planning. Anthony, you did a merger earlier this year. Does that give you a better growth trajectory?
Yes. Well, in the merger is about scale. It's about being able to meet the needs of the client base. And what the client base in the cannabis industry has is a voracious appetite for capital. These businesses are very capital intensive, and most of the capital that they need is around real estate. And so whether they're big cultivation facilities or just building out scale retail networks, the need is massive. And so when we look at growth for this year, we see growth for our business coming in three forms. Number one, we have escalators, so that every year the rent on our leases in place, on our 25 plus leases, will increase every year. So we get growth every January 1st just by virtue of those escalators. Number two is, as Paul was talking about, is the additional dollars that are requested from the existing tenants to continue to build out the properties that we own and that they're leasing from us. And then number three, the pipeline is extremely robust. And our job here at NewLake is to be able to raise capital. And we've raised over $300 million in the last 2 years across 5 raises. We'll continue to raise capital in order to meet that pipeline demand need. So we get it from 3 places: from escalators, from additional tag-on investments, as well as the robust capital need that the market has.
I'd just like to know, is it more advantageous to you to add a new client or tenant to your roster, or to do tenant improvements with an existing client?
Yeah, it's a great question. Both have benefits. In terms of adding additional tenant improvements to our existing deals, a lot of operating leverage in doing that. The documents are in place. The approval process is pretty quick. So that's what I would call the low-hanging fruit. But one of the core tenets of our underwriting philosophy is diversification. Diversification by tenant, by state, as well as by property type, dispensary or cultivation or processing. And so when we look at the opportunities to deploy our capital, we like to keep that diversification in mind. So if there was a state that we're not in that we particularly like, and similar to what was described earlier, we really do prefer limited licensed jurisdictions. If there's an opportunity to get additional diversity, we think that that's critically important for the long-term success of our business and providing long-term value for our shareholders.
And I could also agree with all that, but what we're seeing too is it's great when you have a tenant come back to you for capital, because now you have that partnership relationship. And we've been able to do it 2, 3, 4, 5, 6 times with some of our operators when they come back to us. So it's very important for us to start that relationship, keep it growing. And when you have that type of relationship where that operator is going to come to you first as their capital provider, that's a very valuable thing, I think, in this industry.
Yeah, I think credibility, if I may just add on to that, I think that credibility point can't be overstated here. There are many folks, maybe some who are even watching this right now, who've had experiences where a group has come to them and said, we can provide that capital financing or that capital for your real estate, only to not be able to show up at the closing table. I'm sure all of us could share story after story that we've heard of situations like that. And so what we're seeing is operators are really looking towards groups that have demonstrated success and are more comfortable doing transactions with organizations that have the credibility in the marketplace.
So I guess I'm last again, but it's an interesting dynamic. I think I echo what everybody says. There's going to be a massive demand in the industry. New York's alone going to be $5 billion of build out, and they're going to do it both through sale leaseback and through loans. It's not, and those that have gone sale leaseback, like Curaleaf, love the strategy of sale leaseback, and they do a great job doing it. And some of them have decided, like Verano, to own their real estate, and they intend to own it. So there's no right answer. Everybody picks a different path in doing it, but I think the most important thing is incumbency. We saw that in the middle market when Fifth Street was in a loan. When I did a loan and I had $5 billion of assets, you had a very high chance when they needed more money of them coming back to us. So that's a very strong differentiator is when you're the incumbent lender or the incumbent sale leaseback provider. It's a very powerful thing because you have the documents done and you have the trust in the relationship. And so that's something that we're working hard on is to be the incumbent lender in a number of great firms. As for returns, we just put out our first dividend of 38 cents. We said that was between 75 and 90% distributable income. So we're out earning our dividends. So that we put out publicly, so I can say that. But it's only our first dividend. We have a limited operating history. We've only been public 2 months. But the great thing about the reputation that we provided is when we say we're going to do it, we do it. We have the capital to do it. We close on it. And that institutional reputation is really critical in an industry where if you don't close on it, you may lose your license in a state like Missouri, where they're actually taking back licenses if you don't perform. So if you don't choose a lender or sale leaseback provider that is going to execute on that transaction, you actually can lose your license. And there's other states, I believe, that might happen.
Right.
Yeah. I was going to say, Meryl, I'll throw in. I think it's really interesting when you think about the groups on the panel here. Is everybody has their place. I'm going to disagree with Len a little bit, so maybe we'll spice this up. Where I do think that long term, the industry has no business in owning its real estate. And just the way Starbucks doesn't own their real estate, just the way FedEx doesn't own their real estate, just the way Walgreens doesn't own their real estate, I think what will happen long term is there'll be a point in time where investors really want the operators to focus on the balance sheet and want them to be optimizing that capital structure. So I think there'll be a point where the cost of capital for sale leaseback hits a sweet spot for those operators where they'll realize that investors who are focused on owning real estate are better sources of capital to fund a hard asset. Because if you really think about it, if an operator has $200 million of capital tied up in real estate that has a limited return potential, if they unleash that $200 million into the business to grow revenue, grow sales, expand the business from a CapEx perspective, investors will earn a greater return off of the multiple that they get from deploying that capital into the business versus sitting in a hard asset like real estate that really is limited in what it could generate. And so there'll be a point in time.
Right. And, ultimately, a more robust capital access for the industry as a whole will put all the debt offerings and equity offerings into perspective. I mean, if you can't access the equity markets, you can access the debt markets. Rarely are both sides of the market completely shut. So, I mean, I think that, that basically what I wanted to address before we have to get into conclusion is how long is the runway that you think that you have ahead of you to increase your business and maintain your returns before the banking system, has wide open access, and before federal legalization, even after federal legalization, the banking system will take time to learn the industry and to build a client list and come up to speed. So it's not like federal legalization is going to change things immediately. But how long you think the runway is for business as you've come to know it?
Sure. So maybe I could respond to it first. We're tracking all the lenders that are lending in the space. There's 695 banks that are doing depositor relations on FinCEN's website. 5 to 10% of those are lending directly. So the misnomer that there's no banking for depositors and there's no banking for lending is vastly misunderstood. We're tracking 8 FDIC insured banks lending directly, 1 publicly traded at LIBOR plus 300 to 450. So it's out there, and I don't see the changing of policy changing that instantaneously for the banks. If a bank wants to be in it, they can be in it right now. They just need to set up the compliance and get there. It's actually harder for depositors than it is for lending for most of the banks. And we're tracking 100 private lenders. So we monitor and track every single lender, every single property across the nation with knowing what's happening out there. We need to know what the size of the market is for any particular license class in any particular state, what the average build costs are, what's happening, are there any properties turning around? We have to know that information to make the decisions that we're making at the level that we're making at. So for us, we see this market being able to achieve these returns at least 24 to 36 months at our 15%, but we think it can maintain all the way out to probably as much as 5 years. And the reason that it is for that for us is that we already know what it is for the next 18 months. We also have equity that we're feeding in through an OID discount that is artificially will continue to inflate that yield as the rates start to compress. Our 15% target yield was modeled at a 12% note rate. We're currently average 15.25. So we have plenty of room to compress. We expect that compression to happen over time, but we think we've got plenty of runway to still go. And we hope our investors are not here for the yield. We hope they're here to diversify their own personal portfolio and real estate debt market into an asset class that is more resilient to a real estate downturn or market shift in the public markets.
Yeah, Rob, I'm glad to hear you say that. I've never looked at that in such great in-depth analysis, but that's great to hear because I'm on the same page as far as the length, but I look at it at a different, I look at it at the federal government level, what's going on in Congress, and we follow this very closely because it is probably the most asked question I think we get from investors is, what happens when federal legalization occurs? What's it going to look like? When is it going to happen? I've always been of the impression that it's going to take much longer than a lot of other people might think. And I think even, especially with Chuck Schumer's bill that he's talking about, we haven't seen it yet, of course. I think that's even going to delay things more. I think the Safe Banking Act had a shot this year, but I think as Chuck Schumer has said, he does not want safe banking on the floor for a vote until his bill gets a full vote. So that's going to put everything off until next year. I think the Schumer bill has a very tough uphill climb. We've already seen 2, maybe 5 Democrats that are very hesitant to vote for full legalization, let alone the 10 Republican votes he would need. So I'm not seeing anything meaningful, certainly this year, probably not next year. And of course, if we do get something next year, we don't know what it's going to look like. I think it'll be more of a states' rights because what I'm hearing on the Hill is what the delay on the Schumer bill is. Their staff guys just figured out that, gee, if they deschedule cannabis, that's going to bring the FDA into play. And what does that mean? And it seems like they haven't really thought that through. So it's a very complicated issue if you just deschedule cannabis, how it's going to be treated. So short answer is, I think we have a great runway. I think it's 2 to 5 years before there's any significant bank or institutional capital coming in to compete with us.
So I have to agree with almost everything Paul said. I think he hit it on the dot. But I'll just bring up a different perspective. What is Schumer thinking about? New York needs the tax revenue. New York is in desperate need of the tax revenue. California gets $2 billion of tax revenue. New York's got tons of issues. If you don't think New York's got tons of issues, look at their infrastructure, drive on a road to New York City. This is the senator from New York. They have to uphold states' rights, even if in the 2 to 5 year time frame, because he wants the cultivators in his state. Nobody's going to cultivate in New York if you can go cross border. They're going to all cultivate in California. Why? The climate's so much better. They want the testing company. They want the regulation. They want the dispensary. they have it in their budget that they're going to get all the tax revenue. So I don't know what tree he's barking up, or what. He's obviously not representing the people in New York. I don't know who he's trying to represent by this bill. What they should do for the good people in the state of New York and many other states is they should control their own destiny. They should have states' rights. They should legalize states' rights ultimately. But I agree with Paul. Nothing's unfortunately going to happen this year. I think SAFE Act will compress yields a little bit for us. And I say that it will also help our borrowing costs. But these poor cannabis providers are paying ridiculous amounts of money to deposit their money. There's too much cash. We need Visa and MasterCard to increase demand for our customers. Mm-hmm. So I'm all for the States Act passing, and I hope it does.
Yeah, so without repeating all that, because I agree with all of it, I'm a little bit of a cynic when it comes to Washington acting quickly on just about anything. And so I'll take the over on federal legislation any day of the week and twice on Sunday. I would focus on 2 points. One, for safe banking, when it does pass, when it does pass, I think it's a good thing. I think it's a great thing for the industry. I think it creates increase in sales because they can accept credit cards. I think it improves margin. So it makes all of our clients, makes the MSOs better credit, more profitable. And that's just good for all of us here on the panel. I think, though, in the safe banking bill, what people don't necessarily focus on is that there is a rulemaking period that the bill provides. It's a 6-month rulemaking period for federal regulators. Listen, and I've been around banking for 30 years. There are very few times I've seen federal regulators do anything together in a 6-month period. In fact, we're still seeing some regulations come out from Dodd-Frank from federal regulators. So again, there I would take the over. And again, having been in banks for a big part of my career, banks won't move until the rules are set. And so just because safe banking passes doesn't mean there will be this onslaught of banks that will suddenly show up. And by the way, when they do ultimately show up, they like to do business with companies that have a demonstrated track record of earnings and profitability and cash flow. And not all banks will be comfortable lending to cannabis, just the way not all banks are comfortable with spirits or tobacco, right? So that's yet another issue. So I agree. I think there's a really long runway. And then the last thing I'd add to this is there was a bipartisan cannabis legislation a few weeks ago to provide more funding for research. And I think what you'll find is I wouldn't be surprised later this year and into next year to hear senators saying, I just approved research funding, so let's give that time. And I think that support buys politicians the air cover to push this off, to wait for the research to actually bear some fruit. And then I guess I said one more, but my last thought is, for the operators, it's a little bit of be careful of what you wish for, because immediately when this goes federally legal, the FDA, in my opinion, will become very involved in the business. And I think that the high regulation that the FDA brings in is going to be a bit of a wet blanket for a period of time on the industry, because it will limit innovation, and I think it will limit form factors. But it's a big unknown out there.
If I could just add one little spin last to this, is that the political winds that are behind this is on decriminalization, not legalization. And those are two terms that are conflated into our industry. Decriminalization is for individuals. Legalization is for companies. And any bill forward right now, the political support is on the decriminalization. And that is not going to help this industry where we want to go. And so we just need targeted bills. I'd like to see what Len mentioned. I'd like to see the credit cards be able to use so we could get off cash basis in the dispensaries. And I'd also like to see 280E. If you could just make that go with the state's law, the state's rules right there, those are two really easy targeted things that we could significantly enhance the everybody across the board. And we don't try to do this broad bill. Each time Congress tries to get involved, they keep adding more and more stuff, and you lose more and more support. So I don't see getting 10 senators get past the filibuster in the Senate.
Thank you. That was all really good input. I've been listening to tracks in the conference all day today, and really thought that the whole concept of medical research sort of was in the background when, and I think in many ways it should be more in the foreground. I'd like you to talk about the risks that you see as being the most prevalent in the industry, or as it relates to your business. Most people, when they start talking about risk, start talking about the state regulations. Who wants to start there?
Go ahead.
I'll jump in. When I think about risk for our business, there's a credit element. to a very big credit element to our business. And so we're always focused on the credit risk. And so when we think about risks, we think about what could possibly impair our tenants from being able to pay their rent and continue to earn the margins that they've had. So when I think about that, I actually worry a little bit about the consolidation. I think consolidation is healthy and it's good, but integrating companies is an art. And it takes a lot of really hard work in order to make the integration work. And so we very much are watching a lot of the M&A that's happening and focusing on, are people executing well? Are they taking their eye off the ball? Are margins starting to slip? Are they going to be able to maintain the types of margin growth that they've had and the types of margins they enjoy today? Or will they become unfocused and maybe not even achieve some of the goals of that integration? And then it's the additional scale up. I think that the industry went through a period of hyper growth back in 18 and 19. And I think that during 2020, to some extent, the industry had to catch up to itself from an earnings and cash flow perspective because of the, I don't want to say overbuilding, but the aggressive build out to the platforms. And so we want to make sure, as we're seeing states come online, such as a New York and a New Jersey, and does Connecticut, maybe Pennsylvania, what happens in Ohio, Virginia, New Mexico, all of these states that are coming on, are people managing that growth and that grab for growth in a responsible way. I'm not saying that we think there's an issue out there, but to me, that'll be something we're keeping a close eye on.
Yeah, I would agree. Like any other landlord, your biggest concern is tenants not paying the rent. And, I think we've been really fortunate thus far. We've only had one incident where an operator went into receivership. And very quickly, once the receivership was resolved, we were able to re-tenant that facility in Los Angeles. And that's something very unique, I think, about this industry that people, I think, like to understand, is that we think there's such a demand for these licenses, especially in limited licenses states where most of our assets are, that if there is a vacancy in an asset, the demand for that license, therefore the demand for the real estate, is so great that we think we're going to put another tenant in there real quick. And I'm sure that's how the rest of the folks feel too. It's a good position to be in.
Yeah, from a company perspective, it's really interesting, and we're secured by the cash flows first, as I said, the licenses second, and the real estate third. I think even though we're a mortgage REIT, and we get the first liens on the company and the real estate, when you really think about it, it's about the cash flows, whether the fixed charge coverage ratios, the net debt to EBITDA, or the net free cash flow covenants that we have. Those are your governors. But the amazing thing I find about the loans that we make, and we have a great cultivator in Pennsylvania, the license is worth more than our loan. Just the license, just the bare license, not the 250,000 square foot grow facility that we supported. The C1 facility in Ohio, I buy that C1 license tomorrow for $20 million, and that's greater than the value of my loan. The Florida license that we backed that got bought by Cresco, again, $40 million license, and we had $12 million outstanding. So the license value in the limited license states is so great. It's often in excess of our loan amount. And of course, we're secured by the cash flows and the real estate as well. It's gravy. But we really pay attention to the state-by-state dynamics, what licenses trade for, whether they're transferable, and how to secure them.
Merrill, for us, the concern for us is this is still an emerging market to us, and values can be quickly inflated as people emerge into a new state that just became available. And so as markets stabilize over time, and the rates, sales comp rates start to stabilize and compress, we're concerned about the market moving along. And so we're only originating transactions for 18 months. We don't feel comfortable getting much farther out than that, to make sure that as new cities next to our city might come out with a better tax rate that might compress it over time. We just don't think that could happen with the comment period that would be required for that, and then designing the zone and the entitlements and the build outs within our 18-month period term. The other thing that we concern just as well, that's a broader perspective, is if it was federally legalized, the interstate commerce clause and how that might affect us, and bringing in lower cost CapEx and OpEx operators into higher cost states. And I actually brought that to one of our larger operators And they said that we actually welcome it because 80% of the cannabis of the higher grade is made in California, and it always has been, and it will go across the rest of the country. And if we can operate successfully in California, we can crush anybody. I'm like, that's totally opposite of what I thought, but that was an interesting take. So those are some of the things that we are concerned about and how we're offsetting for the risk. But I think that we've all got ways of de-risking and mitigating that risk in these emerging markets.
Yes, I would agree with that. It's a very young industry, but it's very dynamic, and it's certainly attracting a lot of equity capital, and that's your backstop at the end of the day when you're a lender. Thank you.
Thank you.
Meryl, that was fantastic. Gentlemen, Meryl, fantastic panel. I'm honestly sad to cut the discussion off, to be quite frank with you. But we've learned a lot. You have a huge conversation going in the chat about what you're talking about. So thank you all very much for starting that conversation here on our stream. And I will say, Meryl, you were correct. It was California.
Great. That's fantastic.
Awesome. Thank you all so much. Really appreciate you all being here. We will see you soon.
Thank you,
Len
Meryl.
Tannenbaum, AFC Gamma, Paul Smithers, IIPR, Rob Seacrest Poloris, and Anthony Coniglio. I hope I said that right.
You
New
got
Lake
it.
Capital. All right, y'all. We'll see you
Thanks,
soon.
Elliot.
Thanks.
Bye-bye,
Thank
everybody.
y'all.
Thank you, Meryl.
Fantastic.